Welcome back everybody, Mr. Clark here. Today we're talking about smoothing the curve or a simple moving average. So to simplify what a simple moving average is, we are taking information, let's say it's closing values for a stock. So at the end of the day for the past 5 days, we've calculated the closing value of a stock. On day 6, we're making an estimation of what that value of that stock should be, and it's based off of the average of the previous 5 days. Now, the more days we add in here, the better. So if it's a 7-day, a 10-day, a 50-day, a 200-day, right? The more information we have, the better information we will be able to project going into future purchases or future stock values to make estimates of what the stock's going to be. So what that means for us is if we have closing values for 5 days, day 6, it's an indication of what the value is going to be. Now we don't know for sure what it's going to be. Again, more history is better than less. If we have more information going back, we can be more accurate in our predictions going forward. And so a lot of investors use that information, they use this arithmetic mean of calculating a bunch of values, divide by the total number of values we did, and that information is coming from previous data. We should always look at previous data to move forward. What I mean by that, let me just show you a visual here. If we have a trend going upwards like this, and this is time, and this is the value of a stock, and here's how much days that have occurred. All these are data points that we've collected. Now it's probably more like this, right, throughout time, but we've noticed this line going up, that we can try to make predictions that it's probably going to continue that way. This is still going to be a huge handicap if we just assume that's the case. Housing market in 2008, 2009, well earlier than that really, was an indication of going up. Values were bloated beyond what they actually were, and people just assumed that it was never going to stop. But the problem is, you can only say that house is worth so much before people think, well, maybe not. Maybe I don't want to buy it for that price, right? And with any stock, any purchase that we're going to make, there's a limit on the value that it can get to before it's just too high and it crashes, right? And so we're trying to avoid making that assumption. So what we do is we take the trend data. Let's say this is a 10-day. Probably not, but let's say it's 10-day and there's lots of trade values happening throughout each day. We start at this point and say, what is the average of all this data? Add all this up, divide by 10, and that's going to be a data point. And then as this day occurs, we get actual value. We start in this new range, and now instead of going from here to here, we're now going from here to here. And we keep doing that day in and day out, adding up the previous day and just compounding this and getting a data point more accurate to what we have, or at least a smoother curve. And so now instead of this bulky, jagged path that we're taking, we've got this more smoothed out line. So then that's a better estimate of what's going to happen going forward. Another thing about this, you'll notice what happens. Again, if you have this kind of jagged change in values, you get this kind of, you don't get as high of highs, but you also don't get as low of lows. And so that's also helpful. It doesn't give you these bloated views of what the value could be, which, I mean, yes, it could, but for the time stamp of how long it's there, we don't know. And what's going to happen down here, I mean, unless you time it perfectly, which would be very difficult, you might find yourself selling at a lower value than you purchased it, right? So purchase, sell. We might give ourselves a loss. It smooths out the height and doesn't show as high of a extreme, which is useful for us because then we're not getting greedy. But it also gives us a better indication on the downside, so we don't think it's going to bottom out down here lower, which it may do, but overall it may not. It gives us a better prediction of how the health of that stock is doing. So again, just as a reminder of a mean, an average, it's really just taking values. So 2 plus 3, sorry about that, 2 plus 3, 5 divided by 2, 2.5 would be our output. That's all our average is. The number of values added is the number that we divide by. So going into that, let's look at an example here. So we have this example done, and essentially what I have, five data values that have been averaged together to give us an average or approximate of 35.22. If we were to write this as a 5-day average, or moving average, sorry, then we wouldn't start looking at information until we get to day 6. That's the point where our data starts to have any value, because we're making a prediction of what it is. Technically, I guess you could do it on day 5. We just say at the end of that day that's what it should be at. Notice it's pretty close to this 35.32, but it's not the same, and it doesn't necessarily provide a perfect indicator that it will be that. But over time, we start looking at all this information here, days 2 through 6, 3 through 7, 4 through 8. What we're doing again is we are taking the last 5 days every single time. So on day 6, we're taking the previous 5 days, 1 through 5. On day 7, we're taking 2 through 6. On day 8, we're taking 3 through 7. We are just calculating the past 5 days and looking at what those values trend over time. And then we're graphing this data, again starting on our day 5, saying day 5 is an average of the past 5 days, day 6 is an average of the past 5 days, and we start marking it out. And in our graph here, you can't see it, but I have you can see our regular daily average is this blue line here doing this. And then we have this much smoother line traveling up this way. That red line is our 5-day moving average. But now what I want to look at is we've got another value here, see if we can find it. Alright, here we go. So now in this one, we have this setup of 30 days, and I took just a 10-day moving average. Now again, we have to look at the start date here. This is all previous data that's been included in this data point on day 1, or for us, point 11. Again, that's this value showing up right here. That's this value on the graph right here. And so, well, down here, sorry. There we go. And notice again, that's starting at that point. So we can't estimate anything here on this day. Now, if we're doing this again for the past 10 years, this data is not going to matter anyways, because we'll have something for every day that we move in. But as we move along the time, we can see again our highs aren't as high. And if we could show this graph going even farther, our lowers wouldn't be as low. This jump going on has been smoothed out and giving us a much cleaner representation of everything. This is a graphical representation. All I did was in here, I took the sum of C34 and C13. That's the values here, or sorry, C4 through C13. So here is C4 through 13, and I averaged it and started my own little table here to create a 10-day moving average. Now, one of the things that investors like to look at with this, after they've graphed, is to say, well, what we have is a faster moving average. This is 3 days. This is this data right here. This data right here. If you actually select it, you can see that highlight. And then we have this data here, and then we have this data here. Notice as we go up, if you look at the values going up, we don't go up as quickly or as high on these 7-day moving averages. That's a good. That tells us a more conservative view of what's going on in the future. With the fast moving average, we go down really low. That's good for us too. It's a nice conservative estimate that the market's going to do worse than it is, so that we're a little more careful. So what investors use, they use the intersection of this fast moving average when it crosses the path of these slower, or I guess longer term moving averages. So let's say our 3-day moving average is coming up. When we cross the path of this orange line, or let's say this gray line, when we cross the path, that is a that is a signal to buy, to purchase, because we're saying over time our stock market is going to improve. We should probably buy now because it's going to get better. And then as that starts to drop, when we see this fast moving average cross the other direction, go below the curve, that becomes an indicator for us that it's time to sell because the market is going to drop. I wanted to pull up a screen here. This is just Investopedia. If you're ever looking at, just as an FYI, I guess a plug here for going and doing a little research. Investopedia's got a lot of information on different financial topics. In this case, I pulled up moving averages. A few key takeaways that they've got listed here are important here, but I think the one that I like the most is it filters out the noise. It's really easy to get fearful when it comes to indications of the market to buy and sell. When the market looks like it's going really bad or really good, we make really rash decisions, and sometimes those decisions are not based off of good, solid information. So when we start looking at history, we can start making that determination that, hey, you know what? The market is actually doing better than we would expect, and this is a good time to get in, even though the past maybe week wasn't so hot. It was kind of scary. It was a bit of a roller coaster. When we look at more long-term history, we can start looking at trends and say, you know what, actually we're doing pretty good. On the flip side, when the market starts to tank, we can get a better indication of, hey, we need to sell now because it's going to drop faster with our information when we're talking about the moving averages than maybe a hyped up projection on some internet site might show. And so again, that fluctuation information is important for us. But in general, again, all we're looking at are moving averages. The biggest takeaway, I guess, if I were to say, if we're going to go visualize this, is when we go and calculate these out. Let me just get another graph here. When we're calculating these, we just need to, again, remember we have our day, 1, 2, 3, 4, 5. Let's say we'll put a few more in here so that we can see. We are valuing 1 through 5. This would be 2 through 6. This would be 3 through 7. Again, we're just doing the spread of 5 days every single time. So day 3, 4, 5, 6, 7 would be here. 4 through 8. We're adding those up and dividing by the number of days that we're doing. So these are all averages. And our graph, again, if we're looking at a visual representation of that, we might have something like this. And we're taking into account, let's say, the last 1, 2, 3, 4, 5 data points. And these are the data points that we're going to average together to give us a value. Let's say for here, I guess we can put it down here. Start it there. And then we're going to do that same thing with these 5 data points. And we're going to average those together. And let's say the trend is better going up, and it's going to keep showing this information, whatever that's going on in that trend. We're going to see a much smoother representation of that data. So again, just going back into this graph here, that's what's been done. This is our fast pace. These are our more slower, maybe more long-term averages. When we have a bear market and the market's not going to do as well, the fast-paced is going to take longer to start dropping off. It'll start dropping off faster. I mean, it'll steeper of a drop, this path going down here. But it's also going to come up much faster and estimate a much higher value. Now, the stock market may be there, and that's okay, because if you see right here, you bought, then you're going to see all these values up here. You'll just know that when we get to about this point, we're looking at probably a slowing or a declining of growth. Again, anytime you see a curve doing this, that is an indication that the rate of change is much less. So anyways, make sure you are asking the questions. Hopefully that helps you with this lesson. It is just a simple arithmetic mean. We're just taking a bunch of days in time backwards to predict going forward our decisions. Email me what you have. I'll be more than happy to help. Let me know how I can do that, and we'll get through it. Take care.